Yeah, thanks, Tim. Appreciate it, and thanks everyone for joining us. Well, my focus today is going to be to go through our indicative results for the year. But Tim, if you flip through the first couple of slides, I think we've got the disclaimer there. For those of you that don't know the company, I'll give a quick overview of our background. When we started WT back in 2010, we actually launched under the name of Spring Financial Group, and for the first sort of 7 years of our operation, our entire focus was direct to consumer. And so we had built a large network of salaried advisors providing financial planning advice, accounting and tax services, and mortgage brokerage services direct to consumers out of our offices in Sydney, Brisbane, Melbourne. In the wake of the Royal Commission and some significant industry disruption and the unravelling of, I guess, what had become a completely vertically integrated model where most of the big independent financial advisor groups had been controlled by the banks and product providers, we saw all of that unravel in the wake of the Royal Commission, and we saw a significant opportunity to sort of fill the shoes of some of those players and to fill the void that was left by the banks and others vacating the space. We thought that independent financial advisors could really benefit from all of the many tools and the intellectual property that we'd built in our direct consumer business. So we bit the bullet and took the decision to sort of pivot to become a primarily B2B focused business. We sold off various parts of our direct to consumer operation, and we started our foray into what is known as AFSL licensing services or dealer group services for independent financial advisors, with the acquisition of a small dealer group known as Wealth Today in 2018. And we followed that up with the acquisition then of Sentry Group in 2021, and more recently Synchron Group in March of this year. And so the business along the way changed its name from Spring Financial Group to WT Financial Group Limited. We changed our ticker from SFL to WTL. And here we sit today as one of the largest dealer groups in the country. So Tim, if you could flick onto the next slide just to put some metrics around that. We are third in size in terms of number of advisors and some other key metrics to only Insignia, which is the former IOOF, and AMP, both of which are institutionally owned and operated groups. So we're really the largest non-institutionally owned, non-product producing group in the country now. We have around 600 financial advisors that operate under their own brand names under one of our three cohorts of Wealth Today, Sentry and Synchron Group. We've got more than $16 billion of funds under advice across the network, a very significant in-force annual insurance premium book in excess of $360 million. And we write around, our network writes around $25 million a year in new insurance premium. And our advisors deal with just short of 100,000 retail and wholesale consumers. So how's all that gone for us? Well, it's been quite a journey transforming the business like that, a big commitment made by our major shareholders and the executive team to sort of pivot a couple of years ago. And we've been lucky to have really strong shareholder support on this journey. If you can flick through to the next slide. I suppose FY 2022 saw us complete that Sentry acquisition at the start of the year in sort of late July, and in mid-March as we completed the Synchron acquisition. And that's we've come out with these indicative results because we think we'll be late in the month with our final financial statements, given the complexity around the notes and getting the consolidated balance sheets all done because of those acquisitions. And we wanted to come out with the indicative results at a P&L level to say to everyone, it's been a good result. Gross revenue of just short of 104 million, a gross profit of 11 million, an EBITDA line of just short of 4 million for the year, with an underlying net profit before tax of 2.8 million. At a statutory level, that'll be impacted by a one-off charge of about $400,000 associated with some debt restructuring we did around that acquisition. And so, look, a really good result. From a tax perspective, as we'll have a statutory tax calculation that has still been finalised and will form part of, obviously, our financial statements later in the month. But we have significant carry forward tax losses. So the company will be paying no tax on a cash basis. And if we flick through to the next slide, Tim, we'll see how this plays into now with the Synchron acquisition having made a significant contribution in just those last 3 months. It augurs well for our guidance for 2023, when we will have the benefit of Synchron for that entire period. So we put this guidance out when we did the Synchron acquisition a few months ago. And I think if you look at what we've been able to achieve just with a few months of that, in the FY 2022 year, as you'll see, it gives us the confidence to come out and restate this guidance for this year. So we're looking towards $170 million in revenue, a gross profit of around $18 million or more, an EBITDA line of $7 million, up from that 3.8 or 3.9, net profit before tax up from the underlying 2.825, and assuming a statutory tax calculation of $1 million, a net profit after tax of $4 million. Again, importantly, we've got those carry forward tax losses, but we're also in a unique position in the company of sitting on around $1.4 million of franking credits. So we'll be looking to return to a dividend paying proposition and be able to frank our dividends going forward, well in advance of us actually getting to a position of having to pay tax on a cash basis. So just flick through to the next couple of slides, Tim. People ask us why you're confident about the future of financial advice. Pretty simply, demand for advice is growing considerably in Australia. We're on the doorstep of a very large intergenerational wealth transfer. We've got the largest cohort ever making their way into aged care that need aged care advice. We've got all that intergenerational wealth transfer advice for both those passing the money on and those inheriting it, looking for strategic investment advice, and all the estate planning and legacy planning. So demand is going up at a time when the industry is professionalised, and we've seen a lot of advisors exit. So we've got less advisors dealing with higher demand, able to increase their prices and their margin. And I think that'll about wrap us up time-wise. Tim, if you flick through to the next one, a couple of other points. We've had a real regulatory and legislative burden over the last 10 years in our industry. We've seen that we've had our previous government and now the new government very supportive of what's been called the Quality of Advice Review, looking at cutting a lot of the red tape burden in our industry and duplication of regulation in our industry to help drive down the cost of advice for consumers. So we think that really augurs well for the industry over the next few years as well. All right, Tim, I think I've kept it to about our 10 minutes there. If we flick through to the next slide.
Coming waiting for the next slide, but I'll
here it comes. Here it comes. Fantastic. I won't bore you with the details of the board. A very experienced board from a financial services perspective and also a mergers and acquisition perspective. But most critically, with our board and management, is board and the key executives and employees within our company own around 40% of the business. So there's fantastic alignment between the interests of all shareholders and the board and executive.
Thanks, Keith. I mean, being so aligned probably means that moving forward, there's a dividend policy that's attractive for shareholders. Can I assume that?
Yeah, look, Tim, as we've maintained the company's got a really strong dividend history. We've paid out around $7 million in dividends in our first several years of operation, and certainly trust me as the founder and second largest shareholder of the company and largest non-institutional shareholder of the company, as I'm very motivated myself to see us return to dividends at the right time. We think the right time for that will be during the course of this financial year sometime. So we're not intending to announce a dividend off the back of this profit. We've got We've got some payments to make associated with the back end payments of the couple of large acquisitions we've done. So it's all about prudent capital management for now, but certainly as and when the situation suits us, we'll be back to dividends as soon as possible.
And Keith, you've grown from somewhere near 50 advisors to up to 600, and you've obviously had to integrate a lot of different businesses. You've got different platforms, etc. Do you kind of get some scale costs? There's a question here around PI insurance. Do you get the benefits of kind of scale with some costs that are normally an advisor would wear on their own?
Yeah, but absolutely we do. There's to support a large network or even a smaller network of advisors, you need a certain amount of intellectual property in the business to help advisors deal with their ongoing education and training, with the great diversity of clients they deal with and different strategies they deal with. Once you've got that intellectual property in the business, it is very scalable, Tim. So, look, the headcount's expensive, but in a lot of circumstances with things like education and training, for example, whether you've got 50 people showing up to a session or 500, it costs the same amount of money to deliver. So there's a great deal of efficiency that comes out of getting the scale into the business. Things like PI insurance, great example. There's buying power that comes, whether it's technology or whether it's PI insurance or whatever the other support services are that we need in the business as we pick up that efficiency as well.
And moving forward, what are some of the strategic objectives you have as directors of the business? Well, let's start with that question, and I'll follow up something in a minute.
Yeah, sure. Look, I think really bedding down and continuing to bed down the efficiencies that arise out of the acquisitions that we've done. So I'm very proud of the work the executive team's done already in that regard over the last 12 months and just in a short space of time since the Synchron acquisition. But we need to now really refine that process so that we're delivering services really efficiently to the advisors across the three cohorts, and then help them grow their businesses. We participate in the revenue line of the vast majority of our advisors, and so anything that we can do to help them grow their businesses helps grow our revenue and profitability as well. And that's where that growth in demand in advice presents a really good outlook for our individual advisors and also the company.
And I mean, you've always been optimistic about the financial advice industry, Keith, but not everyone else is. Can you talk through the upside and the potential you still see?
Yeah, well, look, I get that other people haven't been because of the regulatory turmoil and the turmoil that came out of the Royal Commission and so on, and the turmoil created through that vertically integrated model. Well, that's behind us now, and what we're left with is the similar thing that they saw after a major regulatory review in the UK. That is, less players left dealing in an environment where there's increasing demand from consumers. And that's what makes me very enthusiastic about it. There's some issues for government to deal with, and with our new Minister, Stephen Jones, is very motivated to deal with these with the industry, I think. The two key things are how to excite new entrants into the market, because we've got an aging advisor population, which again, for those of us left behind in the industry, it's good, less advisors, more demand. So we need to really confront that issue, and that'll be part of addressing the issue of bringing the cost of advice down so more consumers can access it. So those things are more of a structural issue for government and society to bring the cost of advice down for more to be able to access it. That'll be an additional benefit for those of us in the industry.
And just finishing, you've made some significant acquisitions over the last 12 months. Are there any more planned? Are you opportunistic in that regard?
We'll remain opportunistic. There's no question in that, Tim. But acquisitions are no longer a strategic imperative for us. But we will, we will act opportunistically if they arise. And there's certainly further consolidation opportunities out there. But it's not a strategic imperative now, as we've got the right scale. It's important now for us to deliver for our advisors, to help them build strong and robust businesses, which will make ours more robust in turn and help us attract more advisors into the group. And then also look at how we can diversify our revenue lines now that we've got that level of scale in the business.
Keith, that's all we have time for. Always good to have a chat. Have a good weekend, mate.
Thanks so much indeed. Thanks everyone for joining us.